Hey guys, it is Julie here with TipRanks. Today we're taking a look at 3 strong buy resource stocks. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at 3 companies in the natural resource sector that all come in with a strong buy consensus from Wall Street Analysts. So we're going to take a look at these companies, what it is that they do, and how these analysts are weighing in on the stock's future potential. Just before we get into all of that, this is your reminder to make sure you've downloaded the TipRanks mobile app so you can access all your favorite research tools on the go and the wisdom of thousands of Wall Street analysts. Links are down in the description down below. Now let's get right into these 3 strong buy resource stocks. Kicking things off today, we have TECK Resources. Trading under the ticker TECK, their stock is priced just above $39 per share. Now, they kicked off some big growth last summer and are up 45% the past year, though they've come out fairly flat over the last 6 months and are down 10% in the last 3. TECK is a diversified resource company. They're engaged in the mining and mineral development of copper, steelmaking coal, zinc, and energy properties. They also produce germanium and indium. TECK Resources is one of Canada's leading mining companies. Copper, zinc, and high-quality steelmaking coal are required for the transition to a low-carbon world. They have operations across Canada, United States, and Peru. Copper demand alone is expected to more than 2x by 2050, as it is driven by green technologies, electrification, and energy efficiency. Solar and wind generation need 4 times more copper than conventional power, and over 60% of copper demand growth is from the energy transition. Now, a little bit of history on what's been going on with the company this past year. Back in February, they did announce intentions to split into 2 companies, with Teck Metals and then Elk Valley Resources. Shortly after, come April, they started receiving buyout offers from Glencore, but they have rejected these offers. The Swiss mining company presented an unsolicited offer of $23 billion for a merger, but Teck said that it was a non-starter and reaffirmed their plan to segment their business into 2. Now, this went back and forth for a bit, with Glencore saying they would adjust their offer, Teck still saying that they're not interested, and then move forward a bit, and we are hours before their vote to split the company in 2, and they canceled that. So all things pretty much on hold right now. The company says they'll look at other ways to split and are not accepting buyouts from Glencore. That is a very simplified version of what's been going on the last few months, but just to get you up to speed. They said that their plan going forward is to evaluate alternatives for a responsible separation of our businesses, taking into account the feedback we received. Our goal will be to pursue a simpler or more direct separation. The company's next earnings report will be coming up on July 27th. Where analysts will be anticipating earnings per share of $1.07. Now, they have fallen short for their last couple of quarters here, so we'll see if they're able to pull an earnings beat out of the bag. But in the last report, they did note some positive milestones, including their copper growth strategy. Their stock currently comes in as a strong buy based on 12 analyst ratings, with 11 buys and just 1 hold, and we had 1 analyst increase their price target just yesterday. Overall, the average price target comes in at $53.72, which would be an upside potential of 37% from current prices. Here we can see our most recent rating coming in just yesterday from the Deutsche Bank with an upside of over 22%, and all other analyst price targets are well into those double digits. That analyst from yesterday refreshed their estimates ahead of the Q2 results with a clean coal separation in sight. Second up, we have a company that's fairly well known in the resource niche with Barrick Gold. Their stock trades under the ticker GOLD, currently priced just above $16 per share. Now, they did see some growth here near the end of 2022 and again into the spring, but are overall down 2% this past year and 13% in the last 6 months. Barrick Gold is engaged in the production and sale of gold and also copper. They are a sector-leading gold and copper producer with 16 operating sites across 13 different countries. Their portfolio spans the world's most prolific gold and copper districts and is focused on high-margin, long-life assets. In 2022, they produced 4.1 million ounces of gold. Out of the 10 top gold mines in the world, 5 of them are operated by Barrick Gold. Their next earnings report will come out on August 14th. Their previous one came out on May 3rd, where they came out with an earnings beat. They reported earnings of 14 cents per share, coming in 2 cents ahead of expectations, and revenue of $2.64 billion, beat by $70 million. They said that they remained on track to achieve their 2023 guidance. Their strong buy rating on Wall Street comes from 11 analyst ratings with 9 buys and 2 holds. With an average price target of over $24, that would be an upside potential of 49% from current prices. The most recent ratings came in just this past week, one from RBC and the other from Bernstein, with upsides of 23 and 49%. And for our third natural resource company, we're switching over to fossil fuels with Diamondback Energy. Their stock trades under the ticker FANG, currently priced at $127 per share. They have seen overall growth of 23% in this past year, but are down 5% in the last 6 months. Diamondback is an independent oil and natural gas company. They engage in the acquisition, development, exploration, and exploitation of unconventional onshore oil and natural gas reserves. They operate through an upstream and midstream services segment. Their next earnings report will be coming up at the end of this month on July 31st, and this follows their last earnings where they did come out with an earnings miss, and that was the first one in a while. At the start of May, they came out with earnings per share of $4.10. That fell 23 cents short of analyst expectations, and you can see was the first miss in a couple of years. For that quarter, revenue came out at $1.93 billion. On July 31st, analysts will be anticipating earnings per share of $4.41. Their overall strong buy rating is based on 16 analyst price targets with 13 buys, 2 holds, and 1 sell. Most of those ratings came in following that earnings report back in May, but we do have a couple from the last month. With an average price target coming in at $170, that would be an upside potential of 34%. The most recent rating came in 24 days ago from Piper Sandler with an upside of 44%. Now we do have that sell rating from a couple months ago with a price target of $139 and the rest all up in those double digits. So that is a quick overview of 3 natural resource companies, all with a strong buy consensus from Wall Street analysts. Let me know your thoughts on these 3 companies in the comments down below and which one you think has the best growth potential. I always appreciate hearing from you guys. As always, keep in mind these videos are never a suggestion to buy or sell any specific stock, just providing some information and entertainment and showing you how those Wall Street analysts are weighing in. Please make sure you always do your own research and due diligence before making any investment decision. If you made it to the end of today's video, hit that thumbs up button and make sure you subscribe to the channel as well. Thanks so much for watching. Have a great day, and I'll see you back here next time.